Welcome back to the Deep Dive. If you're trying to get a clear map of where the economy is headed right now, you have definitely come to the right place.
It feels a little like driving in the fog, doesn't it?
It really does. So today, we are diving deep into three really critical and interconnected pillars: the labor market, the Fed's next big decision, and what's happening in housing.
And it's a fascinating mix of conflicting data. I mean, you've got these strong headline numbers, but then you have these serious historical revisions.
Exactly. And the people making the big decisions are stuck without the information they need right when they need it most.
So our mission today is pretty simple. Cut through all that noise and give you the key insights.
The ultimate shortcut. So here's the teaser for you. We saw this huge unexpected surge in September jobs. It looked great on the surface.
Looked like an overheating economy almost.
Right. But when you dig in, you see that the summer was actually far weaker than we ever thought. And that contradiction has created this huge timing crisis for the Fed.
And while the Fed is sort of grappling with this data vacuum, the housing market, which runs on a totally different schedule, is already starting to turn a corner. It's responding to things that happened months ago.
It's a system with a lot of friction and lag. So let's start where all the confusion began, the labor market.
The September jobs report.
Yeah, it landed, and it was a real shocker. I mean, economists were forecasting a pretty modest gain, maybe 50,000 jobs, kind of signaling a continued cool down.
And instead, we got a headline number that just screamed expansion. We're talking 119,000 jobs added in September.
119,000.
On its face, that's a number that says strength, stability. It might even make the Fed think twice about easing up.
But that's just it, right? That strength is, well, it's compromised the second you look at the revisions to the older data.
And that's where the real deep dive begins. The government went back and looked at the numbers for July and August.
And what did they find?
They made some pretty significant downward revisions. They cut a combined 33,000 jobs from those 2 months.
Wait, 33,000 jobs just vanished from the historical record.
Poof, gone. And that completely changes the trajectory the Fed thought we were on.
So how much did it change?
It was so drastic that August, which we originally thought was a modest gain, actually flipped into a loss.
A loss.
A net loss of 4,000 jobs for August. So if you think about it, the momentum heading into that huge September number was basically zero, or even negative.
So that makes the September spike look more like an outlier, not a new trend.
Exactly. It suggests a kind of structural softness was there for 2 straight months.
That's a really key distinction. Okay, so if the underlying trend is weak, a single strong month isn't going to change everything for policymakers. But let's look under the hood of that 119,000 Kutter number. Where did those jobs actually come from?
That's crucial because not all jobs are created equal, in terms of what they signal. The surge was heavily concentrated in less cyclical sectors,
Wow.
Meaning the biggest gains were in healthcare and local government hiring. Now, these are real jobs, of course, but they don't signal broad economic strength the way hiring in, say, manufacturing or construction would.
The parts of the economy that are most sensitive to interest rates.
Precisely. Those core cyclical sectors, they showed much, much more muted growth. So the growth was robust, but it wasn't really broad-based.
And what about the unemployment rate? Did that move?
It did. It actually inched up a little. It went from 4.3% to 4.4%.
Okay, 0.1%. That might not sound like a lot.
It doesn't, but for a Fed that's trying to engineer this perfect soft landing, cool things down without a recession, even a small creep upward gets noticed. It's another little piece of evidence suggesting the heat is slowly coming out of the engine.
And that softening momentum is really the central tension here, isn't it? The Fed is juggling above target inflation with all these signs of cooling.
Which brings us right to our next big challenge. This extraordinary policy dilemma created by a timing problem.
A really big timing problem.
The confusion from the jobs data would be tough enough, but it gets magnified, exponentially when you realize the Fed's policy timeline is all messed up because of the delay from the government shutdown.
Okay, so lay out that timeline for us. When is the decision and what info are they missing?
The Fed's next policy meeting is December 9th and 10th. That's the big one. They decide on the federal funds rate, and that sets the tone for the end of the year.
And the problem is?
The problem is the full comprehensive jobs picture, the report that includes that crucial unemployment rate, won't be released until after they meet.
So they're making their decision basically flying blind. What are the specifics on the missing data?
Because of the delay, the Bureau of Labor Statistics is only going to release partial October data. And critically, it will be without the newest unemployment rate.
And when does the full report come out?
That comes with the full November report on December 16th, which is almost a week after the Fed meeting concludes.
So they will make this huge call without knowing the unemployment figures for October or November.
That's an immense policy gap. It just raises the risk of overshooting, you know?
Right. Either holding rates too high and causing a slowdown, or cutting too soon and letting inflation pop back up.
Absolutely. And missing the unemployment rate is especially painful for them. It's a primary indicator for their whole maximum employment mandate. They're forced to rely on these more volatile monthly payroll numbers and incomplete wage data.
It seems like it would force them to be more cautious.
It does. They'd probably rather wait and get the full picture in January than act now based on half a report.
And we already know the Fed cut rates in September and October. So what's the rhetoric been like from the central bank heading into this very uncertain December meeting?
Incredibly cautious. After the October meeting, Chair Jerome Powell was pretty emphatic. He said there's, and I'm quoting here, no risk-free path.
Which means any decision they make is a gamble.
It is. And he also said very publicly that a December rate cut is not a foregone conclusion.
That phrase, not a foregone conclusion, that sounds like there's some strong internal resistance to another cut.
It does, and the meeting minutes confirmed that. They showed a lot of internal debate, with a clear majority already leaning against a December cut. And that was before they knew for sure they wouldn't have the data.
So that strong September number, even with the revisions, was enough to make them pause.
It gave them enough reason to pause, yes. And now, facing a data void, the default position is often just to hold steady.
Okay, before we move on, let's just quickly define the federal funds rate, just to be clear for everyone listening, because this is where people get confused about their own personal rates.
That's a great point. So when the Fed adjusts rates, they're changing the federal funds rate. That's the short-term rate banks charge each other to borrow money overnight.
It's the cost of money for the banks themselves.
Exactly. And while it influences everything else, bond yields, corporate borrowing, it does not directly set the rate on your credit card or, importantly, your 30-year mortgage.
Those are driven more by the long-term bond market.
And by market expectations about inflation and growth down the road. So if the Fed holds steady in December, it doesn't mean your mortgage rate is automatically frozen.
Right, it just confirms that uncertainty.
Exactly. It confirms the market's view that rates aren't coming down fast until we see clear economic weakness.
Okay, so let's transition from that policy uncertainty to where those previous rate cuts are actually showing up in the real world. Which brings us to housing.
Which operates on its own very delayed schedule.
And what's so fascinating here is how you can see the housing market responding, even with that typical, 45 to 60-day lag.
It's the first real, tangible sign that lower mortgage rates are actually improving affordability and bringing buyers back.
So what do we see in the latest data for existing home sales?
Existing home closings, they rose 1.2% from September to October. Now that's modest, but it was a bit ahead of what people expected.
And compared to last year.
That's the more significant part. Sales volume was 1.7% higher than a year ago. That year-over-year number, that suggests genuine, even if it's fragile, traction.
Now, this is the really crucial insight for you to hold on to. The lag effect. When we see a closing reported in October, when did those buyers actually decide to buy?
Right. Those October closings reflect people who were out shopping in August and September. They were locking in loans based on the rates that were available before the more recent significant drops.
So this modest recovery we're seeing now, that 1.2% rise, that's based on an affordability picture from the summer that was actually worse than it is right now.
Correct. The current report doesn't fully capture the better affordability we saw after the Fed's September and October cuts really started to filter through the bond market.
Which is why the expectation for the next reports is so much stronger.
Exactly. The upcoming data, which will reflect shopping in October and November, should be stronger because it's based on better borrowing costs. The market is slowly catching up to itself.
So the housing market is almost a forward-looking indicator, as long as you account for that lag. But it's not just existing sales, right? The builders are also feeling a little better.
A little. We look at the Builder Confidence Index, and while it's still low overall, those easing mortgage rates helped it edge up 1 point to 38 in November.
What does a score of 38 actually mean for the listener? We hear contraction territory all the time.
It's essential context. The scale goes to 100. Anything over 50 means more builders feel good than bad. So a 38 means the majority are still pretty skeptical, they're facing headwinds. But 38 is the highest builder confidence has been since April. So while the environment is still tough, the trend is getting better. They're less afraid of future rate hikes and stalled sales.
So the takeaway for housing is that even a small bit of easing on rates has a real positive impact. It gets buyers moving and makes builders slightly less pessimistic.
That's the synthesis, yeah. Demand is responsive, and the supply side, the builders, is showing its first signs of willingness to re-engage. And all of this is happening while the Fed is bogged down in its own timing crisis.
It's a remarkable dichotomy, isn't it? A slow-moving sector like housing is actually reacting to policy with more certainty than the central bank that made the policy in the first place.
It just underscores the whole challenge of navigating the economy right now. The Fed has to make this huge decision on December 9th with incomplete information.
Trying to weigh a strong September headline against a weak summer.
Meanwhile, the housing market, completely separate from all that, is just confidently starting its recovery based on the simple reality of past rate moves.
It's a fascinating snapshot of an economy really struggling to find its footing. So we've established that the October housing data is lagging. It doesn't reflect the most recent drop in mortgage rates.
Which brings us to the final and I think most important question for you to mull over as you watch the next reports come out. If the rate easing we've seen recently continues to help affordability, how much higher will those future existing home sales figures actually climb? Once they fully reflect all the shopping activity from October and November, we could be looking at a much more significant rebound than these initial numbers suggest.
All because the current data is hiding the full impact of the rate cuts that are already behind us.
Yeah.
The lag is everything.